Your teen requested a ride, but this time not from you. It's through their Uber teen account. You drive your teenager around, a lot, to their friend Jacob's house, their other friend Jake's house, to James's, to Jaden's, to Jalen's, to...
Mom? This is Jake's house, not Jacob's.
Now with an Uber teen account, your teen can request a ride under your supervision. They'll ride with a highly rated driver, and with live trip tracking, you'll follow along the whole ride to their friends' houses that all sound the same. Add your teen to your Uber account today. See app for details.
Bye, Mom.
This is what you do when you've just found that statement handbag on eBay and you want to build an entire wardrobe around it. You start selling to keep buying. Yep, on eBay. Over that all-black everything phase? List it and buy all the color. Feeling more vintage than ever? It's out with the new and in with the pre-loved. Next thing you know, you've refreshed your wardrobe basically without spending a dime. Yeah, eBay, the place to buy and sell new, pre-loved, vintage, and rare fashion.
And so, Alan, welcome to the show.
Glad to be here, Chris. Nice to talk with you today.
Yeah, we're happy to have you as an official sponsor, and just tell us more about yourself, your background, how you started CityVest, what CityVest is, and we'll go from there.
That could be a couple of hours. I'll try to keep it short. So I'm the founder and CEO of a company named CityVest. It's the culmination of about 40 years of investing experience. I've done about $3.5 billion worth of transactions in real estate, private equity, little venture capital. I ran a hedge fund for about 10 years. I own a SEC FINRA broker dealer. So I've had quite a lot of experience. And after looking at a full array of transactions over that long 40-year period, started investing with my brother. And I feel like I've cracked the code of successful investing by pinpointing specific kinds of transactions for my own money, my brother's money, and some friends. And the business is somewhat grown up around what we started to do about 6 years ago. He's a anesthesiologist in Los Angeles, and he had some bad results from investing in a couple of crowdfunding sites. And so I alerted him that real estate private equity funds had the best performance of any real estate investing. And so after discarding the very large real estate funds, which had $10-20 million minimum investments, found a couple of really stellar real estate private equity funds, but even they had $500,000 million minimums. And it came somewhat naturally, given my experience, that by combining our money with a couple of other doctors, we met that $500,000 minimum investment of this very attractive fund. And that deal went very well. After doing a couple of these, I realized that with the $3 million or so that we had raised from our group of physician investors, that we were actually able to ask for enhanced investment terms. And in real estate, that typically meant that we could get a 12% preferred return followed by an 80-20 split of profit. So that was the origins of CityVest, of our investing our own capital and then getting enhanced terms from sponsors.
That's quite a story, and we'll go into more questions, but the first question is, what's interesting is that a lot of physicians, they get burned initially. They have a bad advisor, or they made a bad investment, and so they realize that they need financial education, or they just need somebody that is reputable and knows what they're doing. That's quite a fascinating story, and it's a lot of ways that a lot of physicians get in. And so in CityVest specializes in bringing a lot of real estate deals to high income earning professionals. And tell me more, what is it about the market that brings you your services, and why you specifically focus on physicians and other professionals?
Yeah, I think what happens in the market is, if you're a sponsor, you haven't done a lot of deals. Certainly, you don't have enough of a track record to have investors give you the money in a blind pool to then go out and do deals. So that would take a lot of trust to give somebody your money and say, go do deals. I don't know, what's going to be in the fund, but here's my money. So that takes a lot of trust. In order to get to that position, you have to have 50 or $100 million minimum of assets under management having done deals. There aren't a whole lot of people that have that level of experience. So as people are trying to get that experience, and I call them sponsors, they want to make a lot of money. And typically they're doing individual deals. They'll say, here's the nice, shiny new deal, focus on that. But a lot of investors neglect to ask the question, what is your audited track record? Because they don't have an audited track record, and they're not going to tell you that. They're going to say, hey, look at the deal, don't look at me. And that's where I think investors go wrong. And they start to look at the deal, and the sponsor starts to explain the deal, but overlooking what is your audited track record? Who's your auditor? Do you have an administrator? How much money are you investing in this project? Has there been a third-party due diligence report on that sponsor so that nothing's going to pop up in the background like liens or bankruptcies that might result in stresses on that sponsor so that he doesn't perform as expected? So I think that individual investors, a lot of physicians will trust other physicians. Frankly, the side gig of other physicians may not necessarily be the best real estate investment that you can make. It would probably be better to find somebody that's been in the industry for 30 years. He has a company, a vertically integrated company, having done brokerage and construction and leasing. And now he's at the point of using all of that experience with a team of people that have been together. They've done 100 million in transactions previously. They have a track record that they're willing to say, here's all the deals that we've done. Hopefully they haven't had any investment losses. And then you can base your judgment on how that person will perform in the future. So the reason specifically that I like to give my money to that kind of investment manager is, in today's market, we've all heard about the bidding wars for various properties. So if you have a sponsor without enough capital, he needs to raise the capital on a deal by deal basis, then he's in a distinct disadvantage trying to bid on a property with money that he doesn't yet have. He's got to go raise it, as compared to a real estate private equity fund that's sitting on 50 or $100 million. He doesn't even need to get a mortgage to close on the property. And when a seller is selling a property, he wants to find that buyer that has the capital to close, isn't going to throw up, oh, I need a mortgage, give me an extra 3 months to close. That's a sponsor who's looking to raise the equity capital. But a real estate private equity fund, he can be very opportunistic. And real estate brokers know who the real buyers are, which are the funds with capital. And if you're a broker, do you want to go to a sponsor that needs to raise the money through crowdfunding? Or do you want to go to a real estate private equity fund that's sitting with lots of capital, wants to do the deal? Yes, maybe what a fund might pay is going to be 15% less, but their ability to close, the comfort that, yes, in 3 weeks or 2 months, that investor can close because he has the capital. So those funds typically get the best opportunistic pricing. They see all of the deals. And frankly, the deals that the funds pass on end up going to the crowdfunders and other people who don't have a fund, who are trying to scrape some money together and acquire properties.
You said it eloquently, and just so many gems of information. And my next question I will add in that when I coach physicians and when they're looking at these real estate investment deals in the passive side, I tell them the number one thing is to vet the sponsor, because the sponsor, their track record, their reputation, their performance, everything rides on the sponsor. So vet the sponsor first, and then you can look at the numbers, look at the deal, and if it makes sense, you can invest in them. So the other, the other question was for physicians. Physicians are a very interesting cohort because they make a lot of money, but a lot of times they lack time and experience. For why are private equity real estate deals most advantageous to physicians as opposed to investing actively in actively managed real estate?
I've just given a lot of reasons why private equity funds are best, but it's going to come down at the end of the day to a matter of trust. Who can you actually trust? And in all of our transactions, let me just give you a glimpse of what we go through in order to vet a manager and bring an offering to investors. We're first reviewing about 700 real estate private equity funds a year, and we sort through them rather quickly. There are that many, and they're fairly easy to locate through the Securities and Exchange Commission database because every offering that's made must seek a registration with the Securities and Exchange Commission. So we look at about 700 funds. We parse through those to find the ones that are a bigger size because we believe that there's less competition for real estate deals when you're buying a property that's 50 million versus a $5 million property. We know that on real estate crowdfunding sites, there's a lot of smaller transactions. It's a feeding frenzy down there. And typically, I like to say that the winner loses because the winner of a bidding process on a $5 or $10 million property typically loses because he's overpaid. While at a $50 million level, that asset, and it typically is more sophisticated buyers, and it's not going to, the bidding's not going to go to a level where the returns are so low that it becomes unattractive because these are professional investors. So we're looking for funds that are typically raising a minimum of 20 or 30 million, and hopefully it's 50, 100 million, even 150 million. So a larger amount of equity that will be targeted at larger transactions. And then once we've narrowed that field down to the larger funds, we start to dig into, okay, who is that fund? Is there an audited track record? Do they have an administrator? What's their niche? And so if all of that goes well, and we've narrowed the 700 down to about 10 per year, on every transaction that we do, we commission a third-party due diligence report from a firm named Buttonwood, and they confirm in writing, and that report goes on our website for every transaction that we do. And the report goes through their actually requesting and reviewing the audit engagement agreement and the administrator's engagement agreement, so they can confirm that they are engaged. And you might think that seems to be going overboard in analysis, but it's clearly not, because there's many people out there. Going back to the greatest fraud of them all, Bernie Madoff, he said he had a audit firm, and as it turned out, it was a one-person firm, and nobody had done any due diligence to validate who that audit firm was. So you really have to do that level of work. Buttonwood also make sure that there's skin in the game for that manager, that they have a minimum investment amount. We require a key man life insurance policy on that key investment manager to make sure that if something happens to him, that the fund can operate going forward using the funds from that insurance policy. They go through FINRA and SEC databases to make sure there's no negative comments or securities violations, as well as background checks on lawsuits, any litigation, drunk driving arrests, bankruptcies. So there's a full array of due diligence that's done. And then the key of what CityVest does is we sign a side letter agreement with each of our funds where their terms might be a 7 or 8% pref, followed by 70-30 split of profits, or 75-25. Some are even down as low as 50-50 split of profits. In all of our transactions, we are typically getting a 12% pref, so a much higher pref, typically 4% higher, and we're asking for 80% of profits over that pref. We would not agree to a 70% split of profits or 60 or anything less than that. So we do go through a significant amount of due diligence and steps just to bring that fund to the market. Unfortunately, we're only allowed 99 investment slots. We set a minimum investment of $25,000 per investor. Typically, these funds have $500,000 or $1 million subscription. The investors couldn't get into these funds if they wanted to unless they had this $1 million minimum investment size. We not only make it accessible at that $25,000 level, but we're also adding better investment terms for our investors.
Yeah, so sounds like CityVest, it allows physicians to access the best real estate private equity funds with enhanced investment terms, verified due diligence, and lower risks. So we'll transition.
That's what I tell everybody is that exact thing. And they say, really, the best terms? Everybody says that. And I say, yes, and these are institutional deals. And many investors say, everybody else is saying they've got institutional deals. A $5 million deal is not an institutional deal. Sometimes even a $10 million deal, $20 million is not institutional. These are big funds. Oftentimes, there are LPs in the transaction alongside us at the fund level. And sometimes I look and say, oh, Goldman Sachs is the LP in this deal. Blackstone is the LP. And they're getting worse terms than us because they have to pay if the LP, they have to pay fees and a promote up to the general partner. And oftentimes we are the co-GP in a fund that is earning those fees off of Goldman Sachs or Blackstone. So we get better terms than those big funds.
So is CityVest, what is CityVest strategy? Does it do multifamily, commercial, apartments? Go ahead and elaborate.
Our favorite sector has been multifamily and is likely to continue to be our favorite sector. I think it's the sector with the least risk. Excuse me. There are some attractive sectors like industrial properties, which are warehouses. The values have gone up significantly over the last 5 years as e-commerce has exploded. But that is I would need to find a superior investment fund manager that knows that space. And until I do, we're not going to be focused in that area. It really comes down to that manager and his capability. We did one fund that was a rehab hospital developer. It is performing extremely well. Mm-hmm. While there hasn't been great cash flow yet because they're developments and they built these rehab hospitals, we're getting closer to the sale of those hospitals. And on that particular deal, in fact, we got a 15%. And I believe that when all those hospitals are sold, likely to a healthcare REIT, we're expecting something like a 20 to 25% net IRR from that investment. So there are different niches. We did a senior living transaction, but I would say 80% of our investments have been in multifamily. And within multifamily, there are sub niches such as workforce housing, student housing, and we have done both of those. We do like right now workforce housing because we see a lot of reasons why lower income employees will benefit from an increase in minimum wage and from the inflation of wages. We know that unemployment is at extraordinarily low levels. I think the statistic I saw this week was it's at a 52-year low. So the number of people vying for workforce housing, where the deal that we're doing right now, in fact, for KCAP Access Fund, they bought 6 properties in Memphis, which is a very strong workforce market with workers that there's a FedEx hub there, a UPS hub, St. Jude Hospital has a significant employee base, AutoZone. So it's a very strong market. And the average rent in this particular, across the board of these 1,200 units in workforce housing, average rent is about $850. We see wages in Memphis going up for those factory workers and other lower middle income workers. And the goal is to spend money on value add improvements so that these employees, there's more demand at these facilities. Those employees will have the extra money as their wages are going up with inflation. And the goal is to get the rents up from $850 up to $1,000 or $1,100. That may not seem like a lot, but a 10 to 20% increase in rents across the board of 1,200 units, they're projecting a 31% IRR on those 6 different properties that they bought in Memphis.
Mm-hmm. You mentioned the value add strategy, and I know some of the listeners may be familiar and some of them may not. Would you please explain what value add strategy is to that sector?
Absolutely. Sorry that I've jumped ahead in my terminology. So real estate is divided up into 4 key areas: core plus, value add, and opportunistic. And just by the name of core, that would typically be Class A properties, beautiful properties, maybe central business district, the high-rise buildings that are newish, maybe they were built in the last 10 years, and there's not a lot of room for rent increases. But you know, that office building in downtown Tampa, let's say, that building is going to stay occupied. And typically the rate of return that you can get from an investment like that is going to be low because there's very little capability to get rents up, but you're not going to lose money on it. So the investors in those kind of investments are typically insurance companies and pension funds, endowments that are happy to earn a 8%, 6%, 8%, maybe as high as a 10% IRR. Blackstone and the very large real estate investment firms that are managing sovereign wealth, billions of dollars, they're looking for those Class A properties that are core properties. We look for that lower end of the spectrum of value add and opportunistic. That's where you have the chance of earning a 15% IRR, 20%, and a couple of our funds are even targeting 30% IRRs. And in real estate, which typically has a lower risk profile than more risky venture capital and even some stocks, in real estate, it's a fairly simple proposition. You buy the building, you rent it out, and that's your business. You're not recreating products. There's no real competition that's going to leapfrog your technology. Obviously, there's no technology. So in a value add proposition, the example that I gave was our current K-Cap investment company bought 6 properties in Memphis. They're fairly run down. Many of them were built 30 years ago. And when they were built, they may have been acquired along the way by a tenants in common group of investors that only wanted the cash flow out of these properties year after year. And so year after year, they became less well managed. They weren't putting money back into the property to make sure that it was a beautiful property. They just wanted their cash flow. Fast forward to 2021, and it looks pretty shabby. They're getting pretty low rents because there's maybe newer properties that are a mile down the road, and they're getting higher rents. So the goal is to find those properties that are a bit run down, that there might be a problem. I remember a couple of different investment fund managers, they like to create their list of problems, because if they can fix those problems, then all of a sudden they can start to get higher rents. If a property is at lower rents and a low occupancy, let's say it's at 85 or 90% occupancy, imagine spending $5,000 per door to put in two-tone paint and carpeting, stainless steel refrigerator, countertops, new bathrooms. In the development itself, you re-blacktop the driveway, you put in a new model unit, new landscaping, repaint the building, you put in a dog run package storage facility, and all of a sudden those people paying $850 are willing to pay $1,100 or $1,200. And not only do you have the higher rent, but you also get your occupancy up from 85, 90% up to 95 or 100%. The result of that is your net operating income, the income that you get from the property, will be higher. That is the goal of a value add strategy, is to get your income up. So then when you're selling a property and you've improved as many units as you can over a 5-year period, you then sell that property at both a higher net operating income, and then that next buyer that might be less integrated, so they're not a vertically integrated investment management company, they might be a Wall Street kind of investor. They come and say, oh, great, we don't have to do any work, therefore we're willing to pay up for this property. And the combination of the higher net operating income and being willing to accept a lower cap, and that's a whole discussion of what cap rates are. That combination is what our managers look for to be able to generate 20% plus IRRs. In the case of our current KCAP offering, they're targeting a 25% plus IRR portfolio wide, although that Memphis 6 property, they're actually targeting a 31% net IRR on that investment.
This is what you do when you've just found that statement handbag on eBay and you want to build an entire wardrobe around it. You start selling to keep buying. Yep, on eBay. Over that all-black everything phase? List it and buy all the color. Feeling more vintage than ever? It's out with the new and in with the pre-loved. Next thing you know, you've refreshed your wardrobe basically without spending a dime. Yeah, eBay, the place to buy and sell new, pre-loved, vintage, and rare fashion.
Earning your degree online doesn't mean you have to go about it alone. At Capella University, we're here to support you when you're ready. From enrollment counselors who get to know you and your goals, to academic coaches who can help you form a plan to stay on track. We care about your success and are dedicated to helping you pursue your goals. Going back to school is a big step, but having support at every step of your academic journey can make a big difference. Imagine your future differently at capella.edu.
Wow. So that's so eloquently stated. And then I'm going to switch gears. So we'll talk about the actual mechanics. So you said some of your funds are 25,000 minimum. And what is the expected holding period before investors see either dividends or returns or the sale of the property? Usually it's 3 to 5 years. What about CityVest?
Yeah, so each of our access funds will pool capital from 99 investors, and then that entire pool of capital, let's say 5 million, is invested in one real estate private equity fund. So our life of our access fund will exactly match the underlying fund. Typically, it is somewhat illiquid. In fact, it is very illiquid for that term of that underlying fund, which will range from 5 to 9 years, depending on the fund. Some funds look to start exiting properties in year 3, 4, 5. Some funds want to hold for 5 to 7 years. So depending on the fund, there is a period of illiquidity. We are seeking to set up a CityVest investment fund so that if you invest in one of our funds and by year 3, your kids are going to college and you need some extra money, or you want to buy a new house and you need an extra $200,000, whatever that use might be, medical expenses, we're hoping to put in place a liquidity facility so that you could sell back that interest if you need to, so that this, if having an illiquid investment, is not an issue for you going forward.
And what are the fees that CityVest charges?
Good question. We charge 1.75% per year in our access fund. And the reason I believe that is a reasonable fee to pay is you have to remember that I've negotiated an enhanced investment return. So rather than the access fund receiving this 8% pref, followed by a 70-30 split or 60-40 split of profits, we've actually negotiated a 12% split, 4% higher preferred rate of return, plus then a higher percentage of profits. So our 1.75% in fees against the 4% higher pref, you will always end up with at least a 2% advantage investing through CityVest. and could be significantly more depending on how much higher percentage of profits we've been able to negotiate with that sponsor. If the underlying fund is at 70-30 and we've gotten 80-20, that would be even more profits that we've gotten from that investment fund manager, so that our relatively small 1.75% per year fee actually doesn't really matter.
So it sounds like it's would be a very attractive potential investment for those that are interested. And I know that CityVest, it has some current offerings towards, and would you care to talk about that for the audience and listeners that are interested in investing with CityVest?
Sure. I've leaked out some information about KCAP. The underlying fund is CAP E Fund 3. It actually is their 8th real estate private equity fund. They have over 400 million in assets under management. And we have signed a side letter agreement getting exactly what I previously described, which is this 12% pref followed by an 80-20 split. If you want to invest directly into KCAP and you want to invest a lot of money, feel free to get your 8% pref. But through us, you can get a higher pref. And on our website at cityvest.com, you will see KCAP Access Fund with that 12% pref, 25,000 minimum investment size. All of the terms are described there. We have a buttonwood report that goes over the background of the manager, their governance. They're investing $2.5 million. It's a total of a $50 million fund. They've actually closed already on $45 million. So they have this last $5 million piece that they're looking to fill that they've given to us. We're seeking to raise that capital before the end of the year. So basically over the next 2 to 2.5 weeks. We actually just launched yesterday on December 9th, and we have about 15 investors in the first 18 hours or so. And so we're well on our way. This is going relatively quickly. I hope that you can post this on a speedy basis so that your listeners can respond to hearing this and go to cityvest.com and possibly make their investment. One other thing I might add. So in addition to all of the due diligence that we've done, we run a daily group conference call. It happens at slightly different times each day. So if your schedule is such that you might have a noon slot available, but you can't ever get on a call in the afternoon, that's fine. There's different times. Some are at noon, some at 5 o'clock, some at 6 o'clock. Those are all Eastern times. And you can get on a group conference call. You don't have to say anything. You can work and learn about what this deal and what CityVest is doing. Or you can ask me, Alan, you mentioned cap rates. I don't know what that is. Can you describe that? I'm happy to make sure that you're educated. You don't have to do the first deal, that this KCAP deal. You can wait until next April and come on a whole bunch of our calls, learn about real estate investing, because I want to make sure that you feel comfortable with your investment size. Now, I would say that at this point, we have a lot of investors. Those 15 investors that have come into KCAP over the last 18 hours, they're mostly people who are in our other transactions. They were probably just going to their investor dashboard where they see their prior investments and looking to see the latest distribution that they've got. They noticed we had a new offering, and they basically hit the button, invest now, filled in their documents. I probably didn't even speak to any of those people because they know what we're about. They read the site and they filled in their documents. I haven't checked the bank account, but I'm sure they've already wired their funds and it's there. And they typically have started out at 25,000 and now feel comfortable after seeing the investment dashboard and getting K1s. Now they're comfortable, and many of them are investing, frankly, 100 to 150,000 per transaction. And as their other crowdfunded investments through other companies are maturing, they're taking that money. They've now discovered CityVest. It's just a better way to invest in real estate, significantly safer, more due diligence, the due diligence report. And if none of those reasons impress you, then we have better investment terms from these investment fund managers who are, we think, some of the best investment managers out there.
Mm-hmm. And for all the listeners out there, Alan's offering and website and contact information will be included in the show notes. And this will be released on a timely basis because I know, when is the closing date for the fund?
You got to have wired the funds by December 27th. So hopefully it doesn't interrupt anyone's Christmas plans, or maybe it's a time that you've already allotted to be taking off, and it gives you the time at home to sit and review our website, learn some of the nuances of real estate investing. You might also click a button at the top of our site that says learn more, or there is a couple of different videos on the KCAP fund and some other videos that we've done with other. We did a video recently with Kevin Foe of Kevin MD, and it's a fairly long video, about 45 minutes, and we go through some of the same information we've discussed here. So that might be helpful to learn more about real estate investing and about KCAP. And we'll have another transaction in January and February as we go about finding what we think are the best real estate investments in the market.
Mm-hmm. And is the fund for accredited investors only, or are there investor requirements? Can you elaborate on that?
Yes, we've tried to make this accessible for non-institutional investors. If you have $1 million, you invest in a $500 million fund, we make this accessible only to accredited individuals. Definition of that is if you're a married couple, income for the last 2 years of $300,000 or more, or there's a net worth test, which is a net worth of $1 million or more, excluding your home, which we can assess through your brokerage account, or you can get accredited investor verification letters signed by an attorney, broker-dealer, or an accountant, or there are also services. The easiest way is probably just send me a brokerage statement that shows the value of your securities, and we can validate that you are an accredited investor.
Awesome. So much information, and it's so wonderful to see that there's so many different alternatives to real estate investing. And I think for high net worth accredited investors that are very pressed for time, that don't have a lot of time for direct active management of real estate, syndications, private equity real estate is the best. And with the right sponsor, you can increase your returns, you can have your time. And so thanks, Alan, for bringing on all your knowledge, expertise, wisdom, and talking to us about CityVest. We'll have you more on the podcast for future episodes, information, the blog, all of these resources. And lastly, how can people get in touch with you? Email, website, contact information.
Sure, Chris, this has been a total pleasure. I'm always happy to educate people who are smart and interested. Happy to field phone calls, emails, messages through our website. The website is obviously cityvest.com, CITYVEST. My direct phone number is 917-747-3091, or you can email me at Alan, ALAN, at cityvest.com. At the website, there are a couple of buttons that allow you to log in. If you just want to get on our mailing list to get emails about our next offering, go to the website. You can fill in your name and email, and you'll get emails about each of our offerings that comes up. That's a good way to stay in the flow. I've already mentioned we have a learn more section, articles and education. There's about 20 different articles, some of which will explain cap rates, cash on cash return, net operating income, internal rate of return or IRR. These are the core foundations of understanding investments. But there is obviously with real estate a lot more that goes into the analysis. But those are some of the core things, and we do explain those on the website. So Chris, thank you for allowing me to tell the CityVest story, and hopefully I see some of your constituents come to the site. Always happy to educate interested people.
Alan, thanks so much, and we'll look forward to having you on future episodes.
Thank you, Chris. Have a great day.
Uh-huh.